Well, good morning and welcome to the Solutions for Success seminar series sponsored by Sim Financial. I am Mark McGill, the Director of Member Relations here at the South Regional Chamber. We are so glad that you are joining us this morning. We just are trying to get more things in our tool belts, provide more services for our members that you can use and take with you and use in your business. We want to thank the folks at Sim Financial, just great partners of ours here at the Chamber. They do many things with us, from the golf outing luncheon to bring you this, and quite frankly, we cannot do these seminar series without great partners like Sim Financial. This is typically where I would have somebody from Sim Financial say a few words about Sim Financial, but we're going to hear a lot about Sim Financial today because our presenter is Tom Ackmann, Senior Retirement Plan Advisor at Sim Financial Advisors. Tom has more than 2 decades experience in all aspects of retirement plans. He knows the ins and outs of retirement plan design, record keeping, compliance, and employee education. Offers a unique perspective that considers the sponsor, the plan, and the participants. Before we get started, please make sure to use the chat room or Q&A to indicate any questions you have. We'll answer those at the end. Tom, good morning. Thanks for joining us. Give us a little bit about the Sim Financial, and the floor is yours.
Sure. Well, thank you very much. And we're grateful for the opportunity to be a part of the communities that we reside in. Sim is a firm. We're across 5 different regions. We've got Mishawaka's a great office for us. We've got Indianapolis, Fort Wayne, Winona Lake, Midland, Michigan. And I think the thing that really sets us apart from a lot of financial planning firms is the fact that we really do the planning part of it. We create real relationships with our clients. Hopefully that will show today in the depth that we go into. Those real relationships turn into real answers to real questions that can turn into a better plan. And being a fee-only advisory firm, we take that risk that says we want you to want us. We want you to work with us forever. And in doing so, we're going to make your life different. And whether it's an individual client, whether it's a foundation, whether it's one of our 120 plus qualified plans, this is what we do. And again, being fee only, it's very collaborative. We work as a team across all aspects of our offerings to make sure that our clients get our best work. And hopefully this will be representative of that today. Nothing more fascinating than 401k talk, 403b talk, any type of retirement talk. So all of you taking time on your Thursday morning to pick this up and be a part of this presentation makes me feel good. What we're going to do today is we're going to talk about a recently enacted piece of legislation, and boy, it is all over the place and a lot of it. And like most things that have to do with 401k plans, the big part is to realize that not everything is going to have to apply. And I'm going to get my screen set up here, and we're going to start at the beginning because it's always the best place to start. With regard to what we're talking about, it's the Secure 2.0 Act. There was a Secure Act previously, 2.0. Well, it's one better, so it must be better. It might be, but it depends. And what I love about my job is that there's one answer to every question in the retirement plan space. Is, can we do this? It depends. Can I do that? It depends. And what it takes is thought, making sure that it's going to be right for you. Not all plans are the same because not all businesses are the same. And even if you've got a plan that's exactly mirroring the plan offered by your neighbor that does the same thing that you do, it's still not going to be the same because people are different. So what I want to do today is talk about the new items that are coming about as a result of this legislation, and do it under the auspices of what does it really mean? Do I have to do it? Because a lot of these things are optional. And do I understand what the considerations are for the various items that are going to be allowed or not allowed on a going forward basis? So very broadly, you can see here that, boy, this didn't pass in the middle of the year last year. This passed at the very end. Congress passed it on the 23rd of December, signed into law right before the new year. Over 90 separate provisions. We're not going to talk about 90 provisions today, so please don't be nervous about that. But as I said earlier and alluded to, as always, devil's in the details. And that's going to come down to timing. Is it optional or not optional? And when do I have to start thinking about this? The answer to that is probably right now. So let's jump in. The first item we're going to talk about is expansion of automatic enrollment. Your plan may already have that. What is automatic enrollment? Automatic enrollment says that if you've got somebody that meets the eligibility requirements of your plan, instead of you going to them and saying, do you want to participate or do you not want to participate? they're automatically going to come in the plan at some rate, some percentage, maybe 4%, maybe 6%, whatever that is. Beginning, and notice here, December 31st, 2024. So starting at the end of 2024, any new plans are going to have automatic enrollment. Right now, it's a choice. Do you want to put that in? Do you not want to put that in? If you don't have a plan and you put it in after December 31st of 2024, you will have to have automatic enrollment as a part of that plan. And you can see with some guidelines, automatic contribution rate defined in the document of somewhere between 3 and 10%. And it also has to have an automatic escalation feature. And what that means is you're going to start at X, but it's going to be X plus 1, and the next year plus 1, and the next year plus 1 to a cap. So that cap, 10% minimum, no more than 15%. And remember, even though you have automatic escalation, it is still the participant's right. It is their ability to get off that escalator anytime that they want. All right. They can say, all right, I came in at 3. Let's say that's what's defined in the document, and I got to 6. I don't want to go to 7. They can stop that, and then there's no automatic increases after that. Now, one of the touchy parts about an automatic enrollment is people, even though they're automatically enrolled, they don't have to stay enrolled. Okay, they can say, I don't want to do this, and they still have that right. And that's what that last bullet point's talking about. There has to be a 90-day unwind feature, which just means that if that participant didn't come to you prior to that first deferral being taken out of their paycheck and put in the plan, if they come to you within those first 90 days, you have to be able to process that back out of the plan and allow them to not participate in the plan. So again, key here, after December 31st of 2024, not optional to be automatic enrollment like it is now, has an automatic escalator, and has to have a 90-day unwind. If you already have a plan, this won't apply to you, but you may want to consider amending your plan to include these features.
Hey, Tom,
Yes,
real quick, your slides are not changing.
they're not. Okay.
I want to
Well,
let you know, we see your front page.
all right. So let me,
So what you're talking about sounds great, but we can't follow along.
all right. Okay. Again, my apologies. All right, now we're moving on. Second piece, modification of credit for small plan startup costs. This is a boon. What is this? This is the government saying, boy, we'd sure like more people to have retirement plans. And you can see there that they're going at it in a big way. Credit of 100% of qualified startup costs for employers with up to 50 employees. So what this does is this acknowledges the fact that a lot of small employers don't have 401k plans. And you can see what that credit is. It's a credit for up to 5 years of $1,000 per eligible employee, but it's going to be tied to employer contributions. So it's not, well, set up the plan and don't give anything. It's if you're an employer and you're making contributions, whether that be a match, whether that be a profit sharing, whatever that is, at that point, you can get some of those credits, and you can see there that, it's a phase out from 51 to 100. So 100 employee company is still considered small, but you're not going to get as big a benefit as one that has under 50. And the other item to catch yourself on there is the fact that if there are employees with more than $100,000 of income, they're not going to be in that employee count. Okay. Increases the age for required minimum distributions. We may all remember that just a few years ago, the RMD was required for people who were age 70 and a half. The first piece of legislation increased that to age 72, and that applies to non-5% owners. If you're an owner and still working, you still have to take your RMD at 72. If you are a non-owner and still working, you don't have to. And if you're not working and you haven't taken anything out of your retirement plan, you can still wait until age 72 to do that rather than age 70 and a half. Starting January 1 of 2023, that's going to be increased again to age 73. And then you can see that it increases again in January of 2033 to age 75. And me being a skeptic, I always thought, well, how in the world, that's delaying tax revenue to the government. How does that happen? Well, they also did some things with stretch IRAs. And I think that this is a reflection of the fact that that's bringing in a whole lot more revenue than what they thought, so they can keep increasing the required beginning date for people who are retiring. All right, the next provision, Sabres match. This is a feature that a lot of people I don't even know exists, that if you make under a certain dollar amount, you can get a tax credit for the amount that you're putting into the 401k plan. If you've got a workforce that there's some low earners, make sure that they understand that and mention that to their tax preparer or if they're doing their taxes on their own, that they look for that in their tax software. Well, now what this is going to do, and it's December 31st of 2026, is what the target date is for taxable plan years beginning after that date. What that savers credit is going to do is going to make it refundable, and it will be contributed to the 401k plan, which is interesting. All right, I'm not going to spend that now, but we're going to make that savers credit a part of a deposit to the retirement plan so that that person has that money working for them until retirement. Now you can say 2026, that's quite a ways off. Well, it's quite a ways off because there's some channels that need to be created. There's some processes that need to occur to make sure that that money can leave as a refund and make it into individual retirement plans. It also creates one credit percentage of 50% for all savers below that AGI threshold of $41,000 for joint filers. And it will be treated as a pre-tax contribution, which just means that when they take it out in retirement, they will have to pay taxes on the money that they receive as a result of receiving these credits over the years. But again, what this is meant to do, encourage people to save, put money in, and then benefit again from the fact that if you're a low earner, you get some more money from the government that gets set aside and can work for you over the long term to get to retirement. Catch-up limits. Catch-up limits, as you know, people who are 50 or going to turn 50 before the end of a plan year can take advantage of catch-up limits. And those catch-up limits this year, for example, normal 401k, 403b limit, $22,500. For people 50 or older, you can do another $7,500. Beginning after December 31st, 2024, those catch-up limits are going to be increased for people who are age 60, 61, 62, and 63. We're going to come back to that in a moment. But what that limit is a higher one for those people in those age groups. There will still be the defined catch-up limit, but if you are over 50, but not 60, you're going to follow the defined catch-up contribution. If you're between 60 and 63, starting after December 31st, 2024, you can contribute more as a catch-up, and that more is going to be the greater of $10,000 or 150% of whatever the limit is in place at the time that this takes effect. So just to kind of give an example, if this were in effect right now, people that were 60 to 63, instead of contributing only $7,500 to the plan, they could contribute $11,250 as a catch-up to the 401k plan, right? For simple plans, there's a catch-up in a simple plan as well. Their number, for example, again, 150% of the regular catch-up amount indexed for inflation. Catch-up for a simple plan this year is $3,500. If this were in place this year, people 60 to 63 could contribute $5,250 instead of the $3,500. Now, some of you might be thinking, what's so magical about 60 to 63? Well, there's a couple of rumors about that. Part of this legislation that gets done at the end of the year in a frenzy. Sometimes things get added, subtracted, done with purpose, done accidentally. Reportedly, the 60 to 63 cutoff was an accident, and there will be a technical corrections bill that will increase that. But we haven't seen that yet, and no guarantee on that. But it does seem kind of strange that just those people 60 to 63 would be able to take advantage of this. Now I'm going to do some foreshadowing here. There's more to come on catch-ups here in a little bit. Next, treatment of student loan payments as elective deferrals for purposes of an employer match. You may have read about this one. This one is all over the place. Notice this is optional. This goes back to my opening comments. There are things that are coming out. Some of them you have to do. Some of them are optional. This is optional. And what this says is that if you've got a workforce that has employees that by virtue of paying back their student loans are finding it very difficult to contribute to the 401k plan or the 403b plan or whatever that is, you can choose as the sponsor to count those loan payments as a deferral for purposes of match. Now, they're not contributing their loan repayments to the plan, but they can self-report the amount that they're contributing as repayment for those student loans. You can apply your matching formula to that. So if I made $2,000 of student loan payments and I make $20,000 a year, I could say, okay, 2,000, divided by my earnings, and then apply that formula or that ratio to the match. And you could choose to say, yep, I get it. Life's hard. You've got these other things at this point early in your life, earlier in your career, but we're going to give you credit for paying your loans back. And we're going to do that by giving you the match in the plan. right? Now, obviously, that would look kind of weird for testing, all of you that are aware of how the testing works, because you don't have any deferrals, but you've got match. Well, the legislation also allows for there to be a separate group of people that, would be loan repayment people, that they're tested separately, so that zero doesn't affect, returns to other people that might be in the plan in a non-safe harbor plan, right? And again, you see there at the bottom, you can depend on the employee saying, I made X amount of loan repayments this year. Please calculate the match that should go into the plan based on what I'm doing. Optional, something that you may choose to do, something that you don't have to choose to do, but you can make that decision before next year if your plan year starts on January 1. Withdrawals, again, optional, again, effective after December 31st, 2023. And this is meant to meet the needs of those people that just don't have an emergency savings set up. And if you think about it, what was it? I saw an article a few weeks ago, over 60% of Americans would not be able to face a $400 emergency, which is, that's tough. So if you wanted to, you could add to your plan to help with that by allowing one penalty-free withdrawal of up to $1,000 a year. Now, penalty-free, remember, they're going to pay taxes on it. That's not going to change. But the penalty-free is that 10% penalty that applies to distributions prior to age 59 and a half, right? So one penalty-free withdrawal of up to $1,000 a year. And it's got to be an unforeseeable or immediate financial need. People are going to self-certify that it is that, so you don't have to get into the business of, weighing on the scales. Was this unforeseeable? Is this an immediate thing? You can repay that within 3 years. And if you do that, you can take another one in that 3-year period. If you don't repay it, then you can only take $1,000 withdrawal per 3-year period. Right. So if you think about that, more record keeping, more tracking, things like that, but might be something that you want to consider based on your employee demographic, how you feel about a benefit like this for your employees. Another piece here, 2 new starter 401k plans, which addresses companies that don't have 401k plans, might address the ease of offering a plan. One of the things, probably the most challenging thing to getting somebody to start a 401k plan is the perceived notion that they're too hard. They're going to take a lot of time. It's not really a benefit. It is a benefit. It doesn't take all that much time. Yes, there's work up front. We always tell our clients, we tell our prospects, yeah, there's work to be done up front, but it's not a full-time job up front. It's work that you do. You can have help with that. Hopefully your providers are helping you with that, but just make sure that, you do those things right, and then it can be set up fine. So what this does is 2 starter 401ks, and you can see that it carries that theme of automatic enrollment. So you can see there between 3 and 15%, but much lower contribution limits. You can see, that it would match the IRA contribution limit, and is something that you can take advantage of. You certainly don't have to take advantage of it if it's not something that's necessary for you. And again, if you already have a plan, the point is moot. This one was a bit of consternation for us for a while, and we're starting to get more details on this. So you may have heard treatment of long-term part-time employees, LTPT, long-term part-time employees. And what this did was this shortened the amount of time, from 3 years to 2 years, where you have to start considering them and offering them the plan if they're working at least 500 hours per year for 2 consecutive years. It used to be 3. Now, where does this really come into play? Let's say that you're a plan that says, all right, eligibility for us is age 21 and 1 year of service. You might have some long-time part-time employees that just never met that 1,000-hour threshold, and you don't have to offer the plan to them, or you didn't have to, right? You may have a cadre of people that, consistently worked over 500 hours, but not that 1,000. They still couldn't be in the plan. Now, beginning for taxable plan years after December 31st, 2024, you do have to offer them the ability to defer into the plan. You don't have to make an employer contribution if you choose not to, but they have to be offered the opportunity to contribute to the plan as deferrals as they would if they were anybody else that had met eligibility. So this applies to 401k plans. This also applies to 403b plans. Now, the question that rose for us was, okay, let's say that we're a plan that has 90 employees that have met eligibility as defined in the plan document, again, for sake of illustration, age 21, 1 year of service. We've also got 30 people that have been long-time part-time employees or long-term part-time employees. Now, if these people start contributing to the plan, are they going to be counted as a participant for purposes of audit? Will my plan go from not needing an audit to going over that 120 participant threshold? Because even if I've got somebody that met eligibility and was not contributing, they still counted as a person for that audit number. So for a while here, we've known this was coming, and we've looked at our clients that have people that would have gone over that threshold and all of a sudden required an audit. And I'll admit, they were kind of nervous about that. My goodness, now we've got another expense to the plan. Well, I thought, and what do I know? I thought, I don't think they would apply it to that would kind of go in the face of what they're trying to accomplish here. They just want to make sure that long-term part-time employees have the ability to save. But what happened was they came out with their ruling and they're saying, all right, if it's a long-term part-time employee that still chooses not to contribute, they won't count as a participant in that count. If you have a long-term part-time participant that is choosing to contribute, they are going to count towards that 120 count for an existing plan, which would then put you into an audit situation where one would be required. Now, the reality is I would have to think based on what I know, which you might think is not very much about technology, but maybe a little bit more about this. Again, I apologize for that. Probably a lot of these long-term part-time employees still aren't going to contribute, even though they have the ability to do so. But that is something to be aware of, something to look at. If you're somebody that's hovering on that threshold, make sure you're asking that question of your provider so that you can get an idea of what the overall effect is going to be, because you don't want to be surprised. Last thing you want is a surprise. Next piece. Now, this is a little bit like what we talked about in those emergency savings or in those previous accounts where you could allow for $1,000 withdrawal every 3 years or more often than that if it's paid back. But this is a plan-linked emergency savings account, right? And this is attached to the 401k plan or the 403b plan. So if you look at this again, effective December 31st after 2023. So after that, it is optional. You could amend the plan, requires an amendment to allow for this ESA to be part of that. And what it is it allows them to save money, more money, or maybe just some money on a Roth basis, okay? Automatically enrolled at a rate not to exceed 3%, but then it stops their accumulation at $2,500. So automatically enroll people with Roth contributions at a rate not to exceed 3% so that they can build up a safety account within the 401k plan. Now you can see here, well, that doesn't sound so bad, and it's not a bad thing, but you can see the additional administrative items in that next piece. If this is allowed in the plan, the participant has to be allowed to take at least one withdrawal a month. And the first 4 withdrawals can't be subject to fees. So, you think about that, that could be an in, out off of the 401k plan because it is a part of the 401k plan. Now, those of you, again, that are very, involved with your 401k, you're thinking, oh my gosh, how do we record keep this? How do we keep track of this? And there's no current guidance from ERISA or code issues related to how do we show this money coming out to make sure that they're not showing it as a distribution of a regular sort from a pre-tax deferral or an employer profit sharing contribution. There's a whole lot of work to be done on this before it can be offered on January 1, 2024 going forward. But just know that this is an option. This is something that you can add to your plan if you've got a number of employees that you think this would be beneficial for. You may want to consider it. You may want to have those conversations with your providers to see what that might look like. But remember, it is optional. This may apply to you, may not apply to you. There's been a rule in the retirement plan space for a very long time that you could not sponsor a simple plan in the same year that you sponsor a 401k plan. So what might happen is somebody might have been sponsoring a simple plan for a number of years, and they get to the point where they say, wow, it makes sense for us now. We've reached critical mass, or to attract the kind of employees that we want, we need to convert this simple IRA to a 401k. And yeah, that happens all the time. But if they wanted to do that in June or in August or September, they could not do that because that would be having a simple and a 401k plan in the same year. This rule takes that away after December 31st of 2023. you can replace your simple IRA with a safe harbor 401k plan at any time, right? So you're not waiting until the end of the year. You say, nope, this makes sense. I want to do that. There's still going to be some of the rules that apply to safe harbor 401k plans. So you're not going to set the safe harbor 401k plan up in December, replacing your simple IRA, because you wouldn't be able to meet notice requirements. Just for example, again, if this is something you have a simple right now and you're thinking about a 401k, still can't do it this year, but just know that you get a little bit more flexibility starting for plan years after December 31st of 2023. SEPs and simples, right now, you cannot contribute on a Roth basis to a SEP or a simple IRA. Now, starting right now in this year, you could. SEP and simple IRAs are designated or can be designated as Roth IRAs. Now, I say it can, but there's no guidance yet. There's no forms, there's no requirements around how you make that election. When do you make that election? How late can you make that election? None of that exists at this point. The other thing that's very interesting too is that if you think about it, simple IRA, those are deferrals. People defer, contribute, they're paid to that. But a SEP is all employer contribution. How does that work? How in the world does an employer make a contribution to a SEP and it becomes a Roth? Well, more coming on that here too, but we don't know yet, but it is possible. And we kind of know, but information is still coming. And I'm going to come back to this here in a moment, but just know that. Now, if you're an employer that has a SEP, don't worry about losing your deduction for that contribution, because the money still goes in as a pre-tax kind of contribution, which means you get a deduction for that. It's going to be the employee's choice to convert that or not to a Roth if you allow for that to happen. Now, this one, I told you more coming on catch-ups, and this is the foreshadowing that I mentioned as to this topic. So you see an asterisk. I love asterisks. Asterisks. Anytime I see that in my reading, I immediately go to that to see, okay, what do they really mean? And you see their catch-up contributions may be made on either a pre-tax or a Roth basis. Well, how is that so different? You can do that now if your plan allows for Roth deferrals. Well, that's true, except beginning next year, or for plan years beginning after December 31st, 2023, a participant whose income does not exceed $145,000, and that'll be indexed for inflation, but if you are under $145,000, you will still retain the choice of, do I want to make my catch-up contribution pre-tax, Roth, or a combination of those two things if your plan allows for Roth, right? If your income's under $145,000, you retain the choice. However, taxable plan years beginning after December 31st, 2023, if you make more than $145,000, again, indexed for inflation, you will not have a choice. If you want to make a catch-up contribution, you will have to make that on a Roth basis. Right? On a Roth basis, you're going to pay taxes on that catch-up contribution. Not the end of the world, but something that goes into planning. Certainly speak to your individual financial advisor. They can put that into your plan. You can kind of see how that will work. But you also have to understand that you're not setting aside catch-up contributions on a pre-tax basis, thereby reducing your taxable income after, or plan years beginning after December 31st of 2023. The other catch here is if your plan does not currently offer a Roth deferral feature, you need to add that. Otherwise, catch-up contributions go away for people that make over that defined dollar limit. So that's a conversation that you're going to want to have with your provider before the end of this year, so that your people don't lose the option to contribute on a catch-up basis if that's something that they want to do. I'm going to let that one sink in for a little bit, because that is going to be very different. It's interesting. I was at a conference a few years ago, and then there was somebody that raised their hand, and it was an IRS representative that was speaking, and they said, "Do you think the government will ever get rid of Roth contributions?" And I'm not kidding you. The IRS agent, started laughing, and they said, "Are you kidding? No, that's how the government gets tax revenue. They're never going to get rid of that." And this is kind of the coming true of that. They said, if anything, we can see them expanding Roth. Don't know how they're going to do that. They said years ago, maybe what they'll do is they'll leave deferral limits as deferral limits, but catch-ups may have to become Roth. Well, here we are. It's not for everybody, but they put an income limit on that as well. So again, these are things to think about. This might be some information that you want to share with your higher earners so that they're not caught by surprise next year if you've got a calendar year plan. This one's effective now, but we don't know how to do it. Nobody knows how to do it. And what this says is that an employee may choose to designate their employer contributions, whether that's match or non-elective, maybe that's profit sharing, whatever that is. They can say, all right, I want my match to be Roth. I want my profit sharing to be Roth. Again, if you're the employer making the contribution, don't worry about losing your deduction. The contribution will be made as a pre-tax, giving you the deduction, but the employee may choose to say, I want that to be in my plan as a Roth. Well, you can do that, but there's the other side of that equation, which means that they are going to have to pay taxes on that employer contribution in the year that it's made, maybe. All right. Because the questions that come into play, again, is when can they make that election? Right now, there's no vehicle for making the election, even though it is effective right now. How do they make that election? When do they have to make that election? If they make that election, can they change their mind? When would it be taxable? Would it be taxable for the year the contribution is made? Or would it be taxable for the contribution year that it was designated? Because, you know, if it's profit sharing, yeah, I'm going to get a profit sharing based on my 23 income, but it's not going to be made until 24. So how do I, and it may not be made until September 15th of 24, if my employer files for an extension on their corporate return. So these are all questions that are out there. Note, optional, you don't have to allow for this. The other part of it, you know, how will that be recorded? Will that show up on a W-2? Is that going to show up on a 1099? Are they going to create a new form to make sure that those employees that make that election are being taxed appropriately? So many questions, so few answers. This is something that if you think you might want to take advantage of it, pay attention to the articles, pay attention to the information that hopefully you're receiving from your vendor, from your advisor, from the people that are to be helping you with these items, right? Student loan matching contributions that we talked about earlier. So if that student is, or that employee is making student loan payments and you're making a match based on that student loan, they can say, well, I want that match to be Roth. And again, they're going to pay their taxes on that current year. Matching and non-elected contributions, not excludable from income, obviously, they're going to have to pay on that and has to be 100% vested when made. So nobody's going to be able to say, well, I want that to be Roth if they're at 20% vesting on your vesting schedule, because how do you unwind that? Lots of considerations. Maybe something that you want to do, if you want to do, just be very flexible, because again, regulations, guidelines are going to come out as they come out. They're not out yet. And just know that there's going to be some work to be done on that. A lot of our clients are taking a wait and see. You know, I don't want to say, yes, we can absolutely do that right now, because we don't know how to do that. And I don't want to get crushed at the end of the year in all these new things that have to be done and documented and so on and so forth. It is only March, so more information to come on that. Catch-all provisions. So those are the big ones, but I wanted to include some other things that, you know, certainly are going to affect you as a plan participant, you know, but also you as somebody who may have responsibility for the 401k plan that's offered by you or by your employer. You know that if people have a vested balance under $5,000, they can be forced out of a 401k plan, 403b plan. That is going to increase to $7,000 after December 31st of this year. And what that does is that just allows people to not linger on your plan. A lot of you have per participant fees from your third-party administrators. If you've got somebody that left and they've got a low balance, this allows you to roll their money out of the plan so that they're not counting in your head count. Maybe you're one of those that sits on that threshold between audit or no audit, you know, brings another couple $1,000s of people that you can remove to give you some more distance between requiring that audit and not requiring that audit. EPCRS is a correction program. You find something, whoops, we forgot to, you know, allow the plan to be offered to whomever. You know, we didn't apply, you know, a profit sharing calculation correct or whatever that is. What this does is that allows you to go through the voluntary correction, okay, unless it was first identified by the IRS. The IRS comes to you and says, you did wrong, we need to fix this. You don't get the chance to say, oh, you're right, let me fix it and I'll get back to you. If they find it first, you lose that option. If you find it, certainly fix it, you know, under that correction program. And that's effective right now. Hardships, if your plan allows for hardship, all right, one of the challenges over the years has been, gosh, I don't want to get in people's business. You know, it's for one of those 6 reasons, if you're using the safe harbor, 6 reasons for a hardship distribution. I don't want to be asking them that. You know, you can count on the employee's self-certification for both the reason and the amount. You know, this participant needs $20,000 because they're buying a new home. I used to have to ask for a copy of the sales contract showing that they needed at least $20,000. I feel uncomfortable doing that. Here, you can count on self-certification. If something ever got pulled for an audit, it's on the person to prove that their self-certification was correct. So you are protected as a plan sponsor. Oops. All right, more catch-all provisions. This is interesting. So plan amendments, if you wanted to change the amount that you're contributing, maybe you have a defined amount in your plan document. We don't see that very much anymore, but let's say that your plan document said that we are going to give everybody a 5% profit sharing contribution because we've done that forever. If you had a great year, which maybe you don't find out until after that plan year is over, you can now amend your plan retroactively to say, we're going to do 7% this year. If you found out that you had a great year after the year was over, you couldn't give that extra 2% if your plan document defined what you were giving. Or maybe you have a defined match amount in your plan document. You can change that up to the tax filing deadline for the immediately preceding tax year. So just some more flexibility to allow a plan sponsor to contribute more if they find out that they have that ability to do so. A sole proprietor first year plan, if you've got anybody that's a solo K, that may not apply if you're all part of companies, but it allows them to make their elective deferral for that preceding year by, again, their tax filing due date. Here's an exception being made to the 10% penalty. So remember, if you take a distribution, a cash distribution from a retirement plan prior to age 59 and a half, subject to some exceptions, typically a 10% penalty applies to that. Legislation that was passed here, and it's effective now, is that if that 10%, if that withdrawal was caused by somebody who was looking for money because their physician has determined that they've got an illness that will likely result in death in 84 months or less, they'll still pay their taxes, but they won't have to pay that 10% penalty. So again, if they've got a bad prognosis, expecting to end in death within 84 months, they'll pay their taxes, but they will be excused from paying that 10% penalty. I promise you we're rounding the corner here. Last page of catch-all provisions. This is interesting. So how many of you, and don't raise your hands, maybe you're going to raise your eyebrows, love sending out disclosures to all your participants on a regular basis, because there are more and more and more and more of those, it seems, every year. But doing those is a bit of a challenge. So Secretary of Labor is required to review the guidance on, what is the purpose of disclosure and how do we do that? And is it worthwhile? But they've got 3 years to figure that out. So I wouldn't expect to hear anything within 3 years, and we'll see what they come up with. Plan amendments. So if you do something with regard to changing your plan to take advantage of some of those items that we've talked about, you've got until the end of 2025 to do so. And again, as we sit here today, there are very few, if any, amendments that are actually available to enact any of those things that are even available right now. And a lot of these aren't available right now. So don't be concerned that, my gosh, I got to get this taken care of real fast here, because they're still working on things. All right. In the case of domestic abuse, plan may, doesn't have to, but it may permit a distribution in the amount of the lesser of $10,000 or 50% of the participant's vested balance. So again, two very specific things here, a terrible illness or domestic abuse where, you have access where you didn't, you don't have to pay the penalty where you did. So something to think about there. Oh, I lied. One more page. Penalty for missed RMDs. I don't know if you've ever had an employee, a participant, if you've ever had, somebody that missed the RMD. The penalty for that, pretty salty, really. It used to be 50% of the missed required minimum distribution was the penalty for missing one of those. Well, now they've reduced that to 25%. And if you catch it within 2 years, at the end of the taxable year in which it was to happen, that penalty is reduced further to 10%. So key there is try not to miss an RMD. And remember, those dates are going, further out anyway, 72, 73, those are the times that are coming up here. But just make sure that your service providers are helping you out and making sure that they're working in conjunction with you for the purpose of making sure that our RMD is being made to the people that need an RMD, because boy, that sure hurts to have to pay a penalty on those things when they get overlooked. Finally, if your plan has qualified birth or adoption distribution provisions, those were a part of the Secure Act 1. Distributions made after the date of enactment you can actually repay those within 3 years of the date of the first piece of that. So if somebody took a distribution for birth or adoption and they say, well, I'd like to pay that back now, they can do that as long as it gets repaid by January 1 of 2026. All right, I'm going to take a breath before we talk about these things. And I'm going to skip the first piece where it says ask questions and just kind of reinforce what I've kind of mentioned throughout the entire presentation. Pay attention to the effective dates. You know, understand that a lot of these things are options. There's not a whole lot that you have to do. There's a lot you can do, and it just becomes a question of, does that fit my plan? Does that fit how we treat our employees? And can we do it? You know, the reality of, can we do these things? We may want to, we may have to delay some of them if it sounds like a good thing for us to do, but we know that they're there. Just knowing that you have choices is a good thing. Knowing that you can discuss and say, does it make sense? Is it something that we want to do? Verify, verify, verify. Make sure that you understand what you're getting into. Make sure that your service providers are explaining how this works. I said it at the beginning, you know, one answer to everything in a 401k plan, it depends. But the other thing about 401k plans, 403b plans, retirement plans is the fact that everything builds on everything else. Can I do this? You can, as long as this and this and this happens. Well, can I do this? Well, you can, unless this or this or this happens. So make sure that you're not just looking at the provision, you're kind of having a conversation with the people that should be able to have that with you to say, all right, well, if we do this, don't forget that will affect this and this and this in this manner. Are you still okay with that? And then you can make an educated decision. Let us know how we can help, if we can help you. And this sounds self-serving, and it's not. Believe me, I'll talk about this all day long. You don't kind of dig into this for 28 years and shy away from conversations. Even if it's just, Tom, I didn't understand what you said. Tom, can you walk me through this, or whatever that is? I'll talk to you. You can see there, that's my specific email address if you want to write that down. If you've got interest in SIM, you know, there's our website. We've got an 800 number if you wanted to talk to somebody here. It's an 800 number, but it actually gets answered by a person, which is shocking. But they will direct you to whatever you need. And it's not an end around, I promise you. If you've got specific questions about this that you're not asking today, keep my address, or keep my email address, keep my phone number. Again, I'm more than happy to discuss. Okay, Mark, any questions that we have at this time?
We do.
All right.
Great presentation. A lot of great information, and yeah, really nice job. So thank you. How do I know when to start a 401k for my business is a question we have.
Yeah, I love that question. So how do I know when it's the right time to start? Research and looking, does it make sense? And what I talk to people about is, you know, applying the value cost continuum. You know, there's a cost to everything, you know. 401k plans cost some money, but there's value too. And if you only look at the cost of it, you know, you can lose the value. If you were somebody that didn't have one right now, I would tell you to look at your employees, talk to your employees. Hey, if we had a 401k plan, do you think you'd participate? And then you'd have to look and say, all right, from an administrative standpoint, it's a cost for the work, but it's also a cost of time. So make sure that you budget for that, and make sure that you have somebody that's going to oversee that and have the time to set aside for the things that have to happen. But then kind of get an idea, you know, okay, we've got 80% of our participants that would love to do this, that are chomping at the bit to have the opportunity to set aside money on a tax advantage basis, whether that's pre-tax or Roth. So that turns into an amount that might get contributed during the year, that might not. As an employer, you know, if you're passing those costs on to the employees, when it's a brand new plan, you can imagine, you know, that gets a little tough. Because, you know, that could eat a lot of what the cost is, or the cost could eat a lot of what those employees set aside. Now, remember, those tax benefits, if you're under 50 employees, or, you know, if you're under 100, but it scales out, you know, look for those new tax benefits that are encouraging small employers to set up plans, because you can offset costs in those first 5 years. You pay for those maybe as the employer, or some portion of those. You're getting a deduction for that as a cost that you're covering for your employees. It's not dollar for dollar, but you can offset that and allow that plan get to critical mass. And then when it gets to critical mass, you know, you decide, well, maybe I do want to pass on those costs to the employees, or some of them, or maybe I want to keep, you know, covering those as the employer, because that's a benefit. That's something that I can talk about in the interview process. Not only do we give you a great work environment, we give you a competitive wage, but you know what, our 401k plan we offer, we're paying most of the cost for that, or some portion of the cost for that. And that makes a big difference, because if we're doing that, that's more of your money that stays in the 401k plan. And after a long term of savings, that's going to make a big difference. So what I would say is find somebody that you can talk to, have them run some illustrations for you. And then that gives you the ability to say, for the cost of X, I can benefit at Y level. And then you keep looking at that and you say that first time, oh my gosh, this makes perfect sense. Or you say, maybe we need to start with a simple, or maybe we need to use that startup 401k that's not going to be super expensive. It's deferral only and allows us to, contribute. Then you can get into further conversations. Maybe there are owners of the company that want to set money aside. Maybe you go right to a safe harbor plan. Well, safe harbor plan, that deferral testing doesn't apply. Depending on how you make the safe harbor contribution, the match or the match contribution may not apply. And then you look at that and say, okay, well, if our group of these people can set aside X amount of dollars, even though the cost is this, boy, that's still a great benefit. So find somebody that you can talk to that would walk you through those and give real numbers instead of just make it as cloudy and broad as what I just did. But there are a lot of considerations. Find a thought partner, find somebody to walk you through that consideration. Other questions?
I think that was the main one. Again, please write down Tom's email address. That's a great, generous offer just to talk to people. As you mentioned before, it's not the most exciting topic, but Tom, you made it really interesting and compelling, and so thank you for your time today. It was really, I think, a very beneficial presentation.
You betcha. And again, it's not empty. We would love to talk to anybody. It's what we do, and it's what we enjoy. So these things make a difference. What I'll do is my parting comment is, if you've got a 401k plan and your participants are like, the 18,000 participants that we're working with, we know that for probably 85+% of those participants, we're the only financial advisor they're ever going to have. And our goal is to get them to the point that when they retire, they need an individual financial advisor, which we are very good at as well. But find those people that will partner with you and care for your employees and have conversations to tell them why they need to do it and how they need to do it, because that's what's going to make the difference in their lives. That's what's going to turn into a long-term employee. There's a huge difference, as we all know, between getting up and having to go to work and getting up and getting to go to work. And if you've got those employees that get to retirement and they've got a choice, they can still choose to come to work, and it's probably because they like it. But those people that get to age 65, 66, and they're coming because they have to, because they didn't make, provision for that date, that makes it a little bit hard. And anything that you can do as an employer to treat this as a benefit, retirement plans are benefits rather than an obligation. Don't treat it like an obligation. Treat it like the benefit that it is. And then you're going to get that admiration. You're going to get the gratitude. You're going to get the affirmation that, gosh, we really appreciate the fact that our employer is doing this for you.
Tom Ackmann, Senior Retirement Plan Advisor, Sim Financial Advisors. Thank you again for your time today. And thank you for being a great chamber partner. We really appreciate all that you guys do for us and for the community. And it's because of you that we're allowed to do things like today. So we really appreciate you, and our members appreciate you. So thank you.
And thank you to the chamber. And again, my apologies for the technical challenges at the beginning.
It's all good. We're all there, man. We've all been there. So you handled it like a pro, and you recovered perfectly.